All right, now we know that the quiet Fed is ready to speak. What will they say? Well, they're going to say their thing on Wednesday when the Fed announces their interest rate decision at 2 p.m. ET. After that, we have the 2:30 press conference where Fed Powell is going to talk to the press, answer their questions. He's also going to talk about things like the dot plot, and we're going to talk about the central tendencies, which outline the GDP, the employment, the interest rate, or inflation forecast from the Fed officials. So there's a lot of stuff that's going to take place on Wednesday, and a lot priced into the market from a lower rate standpoint. So we'll see if they disappoint the market or they believe what the market is saying as far as interest rates going forward. I would think that the risk is more for the Fed to dial back the market just in relation to the risk of inflation and inflation going forward. I don't think they've seen enough data necessarily to say that it's beat, even though we did have a banking crisis, but I could be wrong there. Anyway, if the dollar should go higher, that would mean the euro would go lower. And on the upside for the U.S. dollar would be a break below both the 100 and 200-hour moving averages. That's a blue line and the green line right through here. And then we have traders looking toward this swing area right through here between the 105.73 and 105.85. And this blue line right here, the step blue line, is the overlay of the 100-day moving average. It comes in at 105.68. So you can imagine if it takes another step tomorrow, we're going to be up into that yellow area. And then we're going to work our way toward the top side of this yellow area right through here. So it's going to be in play as well on further downside if the dollar should go weaker. So we could see another move below the 100-day moving average. What's the significance of that? Well, it wasn't that great last week when the market fell below it here because it didn't continue that momentum to the downside. The market moved back above. And then again, on Thursday's trade, the market came down in just below that level and found support buyers. So we need to get below the 100-day moving average and stay below that 100-day moving average. If we look at it on the daily chart, the price had not moved below the 100-day moving average, going all the way back to this day right here, which is back in November of 2022. So breaking below it and staying below it would still be key for the euro versus US dollar from a bias defining level. If we're able to do that, when we look toward this swing area between the 104.84 and 105.33 as next targets for the euro versus US dollar. If we can't get below those levels, guess what? The bias is going to be more to the upside. And also, if we can't get below the 100 and 200-hour moving averages up here, the bias is still to the upside. And then we'll start to look toward this swing area right here and these highs that we saw in trading last week up to 107.59. So be aware of this 100 and 200-hour moving average as a key barometer. Then this 100-day moving average on the downside is a key barometer. On the top side, we'll be looking at this swing area and this swing area right through here for clues in the short term for the euro versus US dollar. Those are the levels that are in play for me. Let's take a look at the dollar versus yen. And I'll take a look at this. I'll take a look at the hourly chart here. And if we take a look at the hourly chart for the dollar versus yen, what do we notice? Well, we noticed that in trading last week, again, it was a volatile trading session. So I don't really get too concerned about the price moving above the 100-hour moving average. Even here, when it moved above it and failed above, these are failures, okay? The market moved above it, tried above it, and failed. It came back. Tried above it, failed. Tried above it, failed, and moved to the downside. So guess what? We're going to need to get above the 100-hour moving average in order to give a more bullish bias here for the dollar versus yen. If we're able to get above that because the Fed is more hawkish, let's say, we'll look toward the 38.2% retracement of this move down from this high to this low right through here at 133.97. Let's call it 134. Get above that level, and we'll start to look toward the 200-hour moving average and the 50% retracement near the 134.70 area up on the top side. But right now, on the top side, the key level to get to and through would be the 100-hour moving average. If we're able to do that, that would be more bullish. We're currently trading way down here, 132.16. So we're still, 118 pips away from that level. But judging from the price action we saw on Friday, it's certainly something that we could do. In fact, if you look at any of the price actions through here last week, the ranges were well over that level. So we certainly can get back up to the 100-hour moving average as it moves to the downside, as it continues to move to the downside. On the downside, by the way, if we go to the 4-hour chart here, I have outlined this swing area through here, and you can see where that level was defined. It was defined actually going back in time, all the way to here, where the market, you just follow this yellow area. You can see a number of different times that the market moved away from it, fell below it, tried to use it as resistance, moved above it, tried to hold it as support, fell below it, came back up to it through here. You get the idea. We even have a gap right through here over a weekend. Got a little messy through here, but the last thing the market did, just took away my line there. The last thing the market did right here before moving to the upside was come into that level and find support. So guess what? This area is going to be a key level in this week's trade. If we get below the 131.29, it opens up the door for further downside to in the dollar versus yen. We start to move into this swing area. So be aware that's going to be a key level. Let's take a look at the sterling versus US dollar. We'll look at the 4-hour chart here. If we look at the 4-hour chart, we are coming up in the early part of this week, testing at the high prices that we saw in last week's trading. If we get above those levels, that open the door for this key swing area on the top side. Again, this is if the dollar should move lower, but the importance of this level is pretty evident through here. Again, it was a we used the level as resistance through here, and then we moved above it here, moved below it here, came up to it, found resistance, and then moved above it, tried to stay above it, tried to stay above it. Last thing it did here was, before moving to the downside, was come there, came right back up to it, tested it, moved to the downside. So you see the importance of this area up here between the 122.62 and 122.82 level. That's if we get above the 02 level. On the downside, I'm going to go back now to the hourly chart. And we go to the hourly chart and take a look at this. What is still going to be key to me is the 100-hour moving averages. I know it got sloppy last week at different times right through here, but the 100-hour moving average is still, if we break below it and stay below it, it's going to be more bearish for this currency pair. And we'll start to look toward the 100-day moving average, which is stepping higher, and also the 200-hour moving average, which is also moving to the upside. Those would be targets on the downside for a stronger U.S. dollar. Would have the pound versus U.S. dollar move back below the 100-day moving average, move back below the 200-hour moving average. What I do like about the 200-hour moving average is what happened right here. Market came down to it, bounced off of that level, and moved to the upside. So watch that 200-hour moving average as well. It is, again, moving. It was moving up to the upside and faster than the 100-day moving average moving upside. So these two are going to converge at some point this week, and we'll see if the price comes down to it and then what happens against it. Let's take a look at the dollar versus Canada next, and we take a look at this currency pair. Things influence this currency pair more than in addition to just the normal stuff about the U.S. dollar. We're having oil prices, which are moving sharply to the downside, have its impact a little bit on it. But even so, let's say when the movements to the are being are helped by the things like the lower oil prices, which tend to weaken the Canadian dollar, keep the dollar versus Canada more to the upside. But we are open up below the 100-hour moving average this week at 137.23. If we stay below that level, that would be more bearish. Look toward the break below the 137 level, which is near this old trend line through here as well. We did fall below that trend line on Friday's trade, but then reestablished support and moved above it. So get below the 137 level, stay below that level, and then start to look toward this area right through here where we have a swing high, came up short of that and then reestablished support against that level. Admittedly, we fell below it here, but then reestablished support before moving to the upside. So this level right through here between 136.57 and 136.65 is going to be a key level on the downside. If the dollar should get weaker, Canadian dollar gets stronger. Now, if the dollar should get stronger, what would we look for? Well, we need to get above the 200-hour moving average right here. That would open the door for further upside potential. Also, in the short term, we need to get above the 100-hour moving average, get above 100, 200, stay above those levels, and that would look toward this swing area through here with a different number of swing highs and then swing lows through here before breaking and finding that level as resistance. And again, right here before moving to the downside. So up here at 138.07, 138.16, going to be our key levels to get to and through on the top side for the dollar versus Canada. Finally, I'm going to take a look at the Aussie versus US dollar. And this currency pair had a nice base against its 100-hour moving average right through here that forced the market to the upside. We had better employment numbers come out of Australia, which helped to push the price to the upside. We did correct on Friday's trade before moving back to the upside and closing above this swing area through here. So that's a little bit more positive for the Aussie versus the US dollar, staying above this level through here. But if we move below it, in contrast, 0.6691. 0.6691, get below that level and we start to look toward the 100-hour moving average. Once again, that comes in at 0.66637, move below the 100-hour moving average, and we'll have traders looking toward the 200-hour moving average in the swing area, get below that level, and opens the door for further downside in the Aussie versus US dollar toward our low prices, cycle low prices for the year and for the month of March. So there you have it. Look at some of the major currency pairs we head into the new trading week. My name is Greg Mikulowski. Good fortune with your trading. Bye-bye now.